You are listening to Retirement Lifestyle Advocates Radio. I'm your host, Dennis Tubbergen. Glad you decided to tune in today. Hey, joining me on today's program in segments 2 and 3 is first-time guest Mr. Simon Popple. Simon is the author of the Brookville Capital Intelligence Report, and I caught up with Simon from his offices in the UK this past week. We're going to talk with Simon about different ways to get exposure to investing in gold and why you might want to consider such a thing. And that's in segments 2 and 3 today. Let me also take this opportunity to inform you of a terrific enhancement to our resource site. Our resource site, as longtime listeners know, is retirementlifestyleadvocates.com. You can go now to that website. Again, the site is retirementlifestyleadvocates.com, and you can download the Retirement Lifestyle Advocates app. The app can be downloaded to your phone, computer, or both. And with the app, you will get access to the weekly podcast version of this program. You'll also get access to the Portfolio Watch newsletter, which is a weekly economic, financial, and investment market commentary that is posted every Monday night at 5 after market close. You'll get access to that with the app. And also, we are now making available what up to this point has been our client-only market, economic, and financial commentary webinar that takes place live every Monday at noon. You can access the webinar live, or you can go to the app and replay it at any time. Also, all the archived versions of the newsletter, the webinars, and the podcasts are there. So just go to retirementlifestyleadvocates.com, download the app, and for those of you that are subscribers to Portfolio Watch, all of our newsletters will be distributed through the app as of October 1. So if you don't yet have the app, you'll need that to get access to all of the resources. The good news is the app is absolutely free, and again, you can get it at retirementlifestyleadvocates.com. You know, as I'll talk about in the next segment with my guest today, Mr. Simon Popple, the Federal Reserve this past week made quite an announcement. They changed a strategy that they have been using for a very long time. I'll give you just a bit about what happened this past week, and then I'll talk to you about how you may be affected. This is from Fox Business News on Thursday the 27th. The Federal Reserve's Monetary Policy Committee unanimously approved changes to its strategy that account for the likelihood of interest rates remaining unusually low for a long period of time. Well, if you've been a long-time listener to the program, you know that I have long said that the Fed will not raise interest rates simply because they can't. Now it seems that they will not raise interest rates. In fact, Zero Hedge reported that Powell unveiled moments ago, and I'm quoting from the article, the Fed is now operating under an explicit average inflation targeting platform. AIT is the acronym. This average inflation targeting platform has the Fed seeking inflation that averages 2% over time. Now, average means that the Fed can overshoot for a while. Now, according to Bank of America's simulations, using this average inflation targeting platform, it might mean no rate hikes for up to 42 years. It's not exactly good news if you're 65 years old today and looking to get safe fixed interest yields on an investment. It means that it probably won't happen in your lifetime unless we have a reset. But that's a topic for another segment. Now, the Wall Street Journal wrote about this as well, saying that the Federal Reserve unanimously approved on Thursday a new strategy that will effectively set aside a practice that has followed for more than 3 decades to preemptively lift interest rates to head off higher inflation. Well, all this means is that in the past, the Fed would raise interest rates before we have an inflation problem. And I have to tell you that to really understand how this works, you have to understand the fractional reserve banking system. And up until March of this year, banks were required to maintain a 10% reserve requirement. Well, what exactly does that mean? Well, that just means that if you went to put $10,000 into your bank would have had to reserve $1,000 but could loan out the other $9,000. And if interest rates are low enough, it encourages borrowing. And your bank would loan the $9,000 to somebody perhaps who wanted to buy a used car. They would pay for their new used car for $9,000 using the loan proceeds. The car dealer would deposit the $9,000 in her bank. That bank would reserve $900 and loan out the other $8,100. That process would continue from bank to bank. So under the fractional reserve banking system, as long as money is moving, money is being created. So in the past, if the Fed wanted to create money, the Fed would just reduce interest rates, people would borrow, money would move faster, and as a result, more money was created. Well, if too much money was being created, and too much money creation can lead to inflation, then the Fed would preemptively lift interest rates so that inflation didn't get out of control. They're now not going to do that. Now, interestingly, since March 26 of this year, as we have reported, banks are operating with a 0% reserve requirement. So not only did reserve requirements earlier this year drop from 10% to 0%, now the Fed is saying that they're not going to raise interest rates, and if you believe the Bank of America simulation, it could be 4 decades before interest rates go back up. Now, if you look at Fed policy, over time, policy has gotten more extreme, and the results these extreme policies have really seen have diminished. I'll give you an example. The Fed ultimately took interest rates to a high of 2.5% before beginning to reverse course and dropping them to almost zero earlier this year. Now, that 2.5% high in 2018 is well below the 5.25% high water mark in interest rates that was reached before the financial crisis back in 2007, and well below the peak of 20% that occurred in 1980. So as time has gone by, interest rates haven't gone back to prior levels, and cuts have gotten more extreme. In addition to that, since 2007, the Fed has been engaging in quantitative easing, which is just Fed speak for printing money. Now, Fox Business News reports in the article that this new strategy pledges that the Fed will use all its available options to boost the economy. And that probably means more money printing now as a result of this new policy. Now, the question is, why is the Fed changing strategies so quickly? Well, you only change strategies quickly when the current strategy is not working or perhaps making things worse. And as we have warned in the past, money printing means that more money printing will likely follow. The Fed back in January, ironically, warned us against the Fed. This is from a Fed release in January. If a new inflation target is too ambitious and the central bank fails to attain it, the central bank may lose credibility, which may render less effective any other policies it pursues. So in essence, the Fed warned us in January about what the Fed might do, and now they have done it just 7 months later. Now, if you haven't already taken time to educate yourself, I can't emphasize enough that you really need to be educated. You really need to understand how money and banking works. And you need to understand what strategies that you might consider for your own individual financial situation. So I would encourage you to download the app at retirementlifestyleadvocates.com. I would also encourage you to go to revenuesourcingbook.com and get a copy of our free best-selling book, Revenue Sourcing. I'll be back after these words with my special guest, Simon Popple. Welcome back to RLA Radio. I'm your host, Dennis Tubbergen. Joining me on today's program is first-time guest, Mr. Simon Popple. I'm very excited to have Simon on the program. I have been reading some of his articles for a period of time. He is the author of the Brookville Capital Intelligence Report. You can learn more about his work at brookvillecapital.com. I would encourage you to do that. And Simon, welcome to the program.
Great to be on it.
So, Simon, let's talk a little bit about your work. Explain to the listeners what the Brookville Capital Intelligence Report is and a little bit about what you do.
Yeah, absolutely. Well, it's a weekly report, what I'm really doing is focusing on the mining stocks. I use a fantasy football team, which is quite common here in the UK. I'm not sure if you have the same in the US, but basically what I'm doing is I'm breaking down the mining sector into the best as far as I'm concerned. But I also then break them down by the companies down by size, so people know what they're investing in. Obviously, some of the companies are several $1 billion in terms of market value. Others are more like perhaps 100 million. And it's very important that people realize that not all gold companies are the same. Likewise, some are actually producing gold already, in which case the gold price is very relevant to them today, and others are simply exploring. And so whilst the gold price is relevant, it's more the exploration results. So I really focus on Canadian and Australian companies and help them raise capital, which means I get a very good kind of daily intake of what's going on, and obviously that's what I share with the subscribers.
Well, we'll talk more about that as our interview progresses here today, but let's talk a little bit about economics. What's going on from your perspective economically that would make it important for someone to consider getting some exposure to gold and silver?
Well, I think there's several things. I mean, first of all, if you look at the typical way that people behave when they move into retirement, they move from higher risk assets, typically equities, into fixed income. But a lot of fixed income assets have actually got either a negative yield or a very low yield, and certainly not a yield that you can live off. And so I think that people are having to look elsewhere. A lot of people have been looking at the equity markets, and I wouldn't suggest that they have no equities, but if you look at what's been happening to dividends, there was recently an article in the UK, our FTSE 100 has got 49 out of 100 companies either slashing their dividends or stop paying them. So if you're someone who's looking for income from fixed income and equities, then you could be facing some challenges because that income may not be there. Whereas a lot of gold companies are not only maintaining their dividends but actually increasing it, because the gold price and lower energy prices mean that they're, I'm not sure what the opposite of a perfect storm is, but perhaps perfect paradise or something. But they are they're doing very well at the moment and generating a lot of cash.
Well, and I think it was April of this year, Simon, that there were 80-some U.S. listed stocks that either significantly cut dividends or eliminated dividends. So that's certainly a worldwide phenomenon. As we are recording this interview just a few days before it airs, the Federal Reserve is meeting, I guess, virtually. And it seems that they've just come out and decided that, we can allow a little bit more inflation. How do you read what's going on with the Fed presently?
Yeah, well, I mean, it's interesting because the Fed has really moved from an inflation target to sort of more of an average inflation target. And given inflation's been running below the 2% target, now they're talking about an average target. I think it was an average of 2%. So that would imply that they would be happy with inflation running above 2%. Whilst 3-4% probably is not a major issue for people, I'm not sure the extent to which they can control inflation once it sort of gets to that level. And with someone on a fixed income, I would be concerned about inflation sort of eating into savings. Especially if you're getting a sort of a 0.5% or negative return on your capital, and then you've got inflation eating into it. You should really have something in your portfolio that will help you with your purchasing power.
And, I think a lot of people on a fixed income, Simon, are looking at just the price of groceries. I mean, when you look at food price inflation presently, at least here in the U.S., it's hard to believe that the official inflation rate is accurate. In fact, the Chapwood Index, I've had John Williams from Shadow Stats here on the program. A lot of the alternate measures that arguably are more accurate have inflation at 9 or 10%. What would your perspective be on that?
I would probably agree with that, to be honest, because just looking at food, at the end of the day, the whole idea is you maintain your purchasing power at the very minimum. I mean, if you can buy some milk for $1 today, then with your income perhaps increasing through an annuity or whatever it is, that means you've got, let's say, $1.02. You want to be able to buy that milk in a year's time at $1.02. If that milk's going to cost you $1.08 or $1.10, and your income has only grown to $1.02, it's starting to hurt you. And I think that this is something that people have probably perhaps thought about but done nothing about for a long time. Interestingly, I'm not sure if you saw this week, but Warren Buffett, who's always been rather disparaging about gold, in their latest report, it showed that Berkshire Hathaway are actually exiting airlines and selling down from their bank positions, and they've actually bought into Barrick Gold, which is very unusual for someone like him. And just to add to that, in fact, if you look at the performance of the gold price versus Berkshire Hathaway share price over the last 20 years, you'll see that gold's actually outperformed Berkshire Hathaway, which I was stunned about, to be honest. I didn't believe it, and I had to Google it to prove it to myself as much as anything. But yes, I mean, I think gold is it's certainly something that people should consider.
So when you look, Simon, at global debt, and then in response to COVID, there's more government stimulus spending. Obviously, there's no money in the proverbial checkbook to pay for that spending. So essentially, we're seeing printing and spending take place. To what extent do you think Mr. Buffett looked at what's going on globally and the money printing, and to what extent do you think that played into his decision to invest in gold?
Yeah, I mean, it's very difficult to kind of get inside people's heads, but I mean, I think that it's certainly a consideration. If money has been printed, I mean, global debt is going through the roof, and I think there's always been a belief that you could perhaps inflate it away, and if you inflate it, then you can bring the debt pile down, which is true. But then I think the other thing you need to think about is that if you do that, then it's very difficult to issue new debt at anything like the same rates as a previous debt, because no one really wants to buy it. Because if you lent $1 that could buy a pint of milk, and 5 years later your money is paid back, and you can't even buy a quarter of a pint or a liter of milk, then you want a greater return the next time you lend it. to make sure that you've at least maintained your purchasing power. And I think that's one of the reasons why gold is getting a lot more interest from people, because they are concerned about their purchasing power moving forward.
So, Simon, let's just say that someone's listening to this. They're retired. They're on a fixed income. They have maybe some money in a retirement account. Why does gold serve as an inflation hedge? That's a question we get here on the program a lot. So if someone's sitting there going, okay, I get inflation, I get that money creation has the potential to create big inflation, why is gold the best place to be as far as an inflation hedge?
Well, I mean, I think you need to look at gold very carefully. I mean, because there are periods where it's been a fantastic inflation hedge, and that there are periods where it hasn't. But I think the important thing is to have at least some in your portfolio, because there's a lot of things that people have in their portfolios at the moment that are certainly not inflation hedges, and therefore it makes sense for people to think about having at least some gold in their portfolio. And I mean, I've got some in my SIP, which is basically my private pension, and I've managed to treble the value of that using sort of mining stocks. And obviously, I deal with this market on a sort of daily, hourly basis, so I know a lot about it. But even some of my subscribers have done very, very well. But I think the important thing is to have some exposure. I mean, I don't think you want to jump in with 2 feet, but most people have absolutely no exposure whatsoever to gold, and I think that's a mistake.
Well, we are chatting today with Mr. Simon Popple. Simon is the author of the Brookville Capital Intelligence Report. The website, if you'd like to learn more about his work, is brookvillecapital.com. And Simon, we've got about a minute and a half left in this segment, so let's just briefly, then we'll pick up on this in the next segment. Let's talk about the different ways someone can get exposure to gold in their portfolio, and maybe just a brief recommendation.
Yeah, I mean, I think there's 3 ways that people should look at. The first one is to buy physical gold. And if you're going to do that, I'd suggest you buy it through a reputable dealer, because at some point you're going to have to sell it, or you'll probably sell it, or someone in your family will sell it. And if it's been bought through a reputable dealer, then it'd be much easier to sell. Another route is the ETF market. And that can be a cost-effective way of holding gold. Personally, I'm slightly concerned about it because of all the counterparty risks. There's quite a few links in the chain, and everyone has to do their job for the ETF to hold true. And so I'm slightly wary of that, but they can be a very cost-effective way of having exposure to gold. And the third area, which is where I really focus on, is the mining stocks. People need to look at that. It's the most volatile market, but with a bit of help and having a diversified approach, you can get some good exposure to companies that are actually producing gold out of the ground.
Well, we'll pick it up in the next segment with Mr. Simon Popple when RLA Radio returns. Stay with us. You are listening to RLA Radio. I'm your host, Dennis Tubbergen. Joining me on today's program is Mr. Simon Popple. Simon is the author of the Brookville Capital Intelligence Report. You can learn more about his work at brookvillecapital.com. That's BROOKVILLE capital.com. I would encourage you to check it out. And Simon, let's just jump in. We talked about 3 ways, or you mentioned 3 ways to get exposure to gold in one's portfolio. 1 is to buy physical gold. 2 is to buy an exchange-traded fund. I would share your concerns about certainly some ETFs with that counterparty risk. And then the 3rd way is mining stocks. So let's just, for this part of this segment, talk about the price relationship or the price movement relationship between physical gold and mining stocks in a typical environment, if that's a fair question.
Yeah, no, absolutely. Well, I mean, what I like about the mining stocks is, and we're talking about the producers here, not the explorers, because the explorers, a very different game, and you need to understand what you're doing. I do cover it as well. But let's just focus on producers for now. What you basically have is the revenue line, which is very much down to what they produce and the gold price. And so the higher the gold price, the more that they obviously sell their gold for. Now, I think the important thing for listeners is, you can't print gold. Gold, funnily enough, arrived from outer space thousands, if not millions of years ago. And, it's a precious metal, and I think it's one of the few tangible assets that's recognized as being valuable sort of anywhere in the world. But just looking at the simple economics, it's obviously expensive not only to find gold, but also to extract it. Now, finding it is more to do with perhaps technology, but extracting it is very much down to energy costs. And if you can imagine, it is not cheap to build a mine and build a processing plant. So energy costs are very, very relevant. So I think what is particularly attractive about the mining sector at the moment is not only do you have a high gold price, and silver has been improving as well, but given the reduction in oil prices, the energy costs have gone down as well. So that is why you've got some companies producing some very good results, and I think probably one reason why the sector's caught the eye of Berkshire Hathaway and Warren Buffett, and people are investing in the sector who perhaps previously haven't looked at it.
So I read varying reports, and I'm asking this question, I guess, as much out of personal curiosity as for any other reason. What, if this is fair, is an average cost to produce an ounce of gold? Is that a fair number to ask about?
Yeah, it is. I mean, if you look at the World Gold Council, which is the sort of a recognized expert body on the gold sector, they've got what they call the all-in sustainable cost, which is sort of capturing all the costs, including some exploration costs of producing the gold, and they've got that sort of between $1,000 an ounce and probably $1,100 an ounce, I think it's somewhere in that range, but that's given the gold price at the moment is sort of $1,950, you've got quite a nice buffer there between your costs and your revenue. Now, obviously, that's an average, so some companies will be lower, some companies will be higher. But I think if you're looking for a generalization, then something of the order of sort of $1,000 an ounce to $1,100 an ounce is not a bad yardstick to use.
So it just strikes me, Simon, that if you see gold prices go up $100 an ounce, the profit percentage or profit numbers of a particular producing mining company go up exponentially to the price of gold on a percentage basis. So is that a fair assessment, and is there a general rule of thumb as to the relationship?
Yeah, I mean, it's very difficult to sort of give rules between, if the gold price goes up, your costs are likely to go up as well, but probably not by as much. And I'll give you an example that if the gold price goes up and someone who's a geologist who's working for a company, or a miner that's working for a company sees that the company is making an awful lot of money, and there's other mining companies in the region, they're not stupid. They'll know that these companies can afford to pay them more, and so they may increase their wages or wage demand slightly. But I think if we get a gold price that really is taking off, then I think it's unlikely that the costs will go up as much as the gold price, and therefore you get this expanding margin, which is what is exciting people about the sector.
So when you look at producing mining companies and you make recommendations in your newsletter, what are a few of the things you look at? What are the selection criteria that you consider?
Well, I use what's known as what I call the bridge system, which it's an acronym for balance sheet, resources, infrastructure, diversification, grade, and exploration potential. Now, the balance sheet, you want to be careful about companies with huge amounts of debt. Now, typically producers with large amounts of debt were absolutely fine, but because of COVID-19, there have been mines that have been shut down, and if these are a flagship mine and you've got a large debt repayment and you can't, you've only got one mine, then you do need to be careful. So I think that people they need to look at where the mines are, how much debt is in the company, and perhaps how long the mine life is, because that gives you an idea as to how long the cash flow is likely to go for. And then obviously it's nice if you've got a company which has got a lot of resources. These fall into various categories that I discuss in the newsletter, but you want a company that's got a lot of reserves, because reserves are the highest category. You've got probable and proven reserves, and you want as many of those as you can, because that gives you confidence that there's gold that can be mined in the future. Also, it's nice to have a good amount of resources, but that's where some of the other aspects come in. That you want the resources to be economic, and so ideally you want an infrastructure around economic deposits. So I'm talking about power, water, roads. So if you do start mining, then there is an available infrastructure for you to use. You don't have to build it yourself. Diversification really is more it's on two levels. On the one hand, I like to have projects where there are several different assets within a company. So if one asset doesn't work out, or there's problems, then you've got other sources of value in the company. But also, diversification, I think it's important across metals. So perhaps have some gold, silver, and some other precious metals. And I think diversification in terms of geography as well. You don't want all your assets in one country. It's good to have assets across several countries. And then exploration potential, really, that's very much about having the potential to get more resources, and people like a bit of hope value with a stock. That's more to do with explorers, but some producers have got great exploration potential as well. So they're using some of their cash to explore that in the hope of finding some large deposits. And grade again is important, but you need to be very careful with grade, because you need to look into how easy it is to extract the ore, and just having a high grade. Normally it points to a nice deposit, but you do need to make sure that it is going to be feasible to extract it commercially, economically, and enable the mining company to make money.
So let's talk briefly, Simon, about the explorer companies versus the producers. What type of investors should, in general, think about investing in explorers? It seems to me that would be a bit more speculative. What's your take?
Yeah, no, absolutely. I mean, explorers are a lot more speculative, and I think that you do need to be very careful if you're looking at that market, because there's also a sort of a time angle to explorers, because they can explore for years and years, and what tends to happen is an explorer, because they're exploring, not producing, they're not generating cash. So if they are exploring and not finding gold, then providing they're looking in a prolific area, what they'll do is they'll then raise more cash by issuing more shares, which is diluting existing shareholders. And generally that's okay to happen a few times if they don't find much. But if you could imagine that these exploration programs generally aren't cheap. And so if you've got an explorer that keeps raising more and more equity and is not finding what they're looking for, then that can be tough on the shareholders. But if they do find what they're looking for, the shares, they can go up 5, 10, 15, 20, 50, even 100 times. So it really is very speculative. So if people are looking at that market, I would only recommend having a very, very small percentage of your portfolio in explorers, and I think that's more a case of probably having a bit of fun than sort of using it as a sensible investment strategy.
Yeah, we're chatting today with Mr. Simon Popple. He is the author of the Brookville Capital Intelligence Report. You can get more information about his work at brookvillecapital.com. Time for one quick question, Simon. In this environment with gold prices, reaching new highs, is the universe of mining companies expanding, or are we not seeing much change?
Well, it's interesting because in the last, let's say, bull market, a lot of mining companies burnt through a lot of their cash on exploration, and this didn't go down very well with shareholders. So, given that gold comes from outer space and you can't print it, I think what we're going to have this time round is a lot more M&A, where they buy some junior companies that have already got a good resource with the potential for a lot more. And so, what they'll be looking to do is to use their shares and the cash they're generating to essentially monetize some of these junior companies and bring them into production sort of earlier than they otherwise would. And I think that could be attractive for some of the juniors as well, because if you're the manager of a junior mining company, you can't really sell your shares, because if you do, the market's going to get pretty upset, and you'll probably find that your share price tanks if the CEO is found selling his shares. But if a company gets taken over by one of the majors or an intermediate, and rather than having 20% of the shares, you've probably got 2% of the shares in the enlarged. It's much easier for you to strip your shares onto the market and to realise some value from them. So I think that could be very attractive to some mining executives from the juniors.
Well, the clock says that we're going to have to leave it there. My guest today has been Mr. Simon Popple. He is the author of the Brookville Capital Intelligence Report. You can learn more about his work at brookvillecapital.com. Simon, been a pleasure chatting with you today. Love to have you back down the road.
Really enjoyed it. Thank you very much.
We will return after these words.
Welcome back to Retirement Lifestyle Advocates Radio. I'm your host, Dennis Tubbergen. Glad you decided to tune in today. Hey, if you weren't listening to the first segment of today's program, let me remind you that you can go online and visit retirementlifestyleadvocates.com and download the Retirement Lifestyle Advocates app. The app allows you to get access to the podcast of this program, as well as the weekly, up to this point, client-only webinars that tell you what's going on in the economy, the markets, from our perspective, as well as the weekly Portfolio Watch newsletter. So again, the website is retirementlifestyleadvocates.com. Also making available this week a copy of the Revenue Sourcing book. It was a #1 bestseller a few months ago in 4 categories with Amazon. You can go to revenuesourcingbook.com to get your complimentary copy. In this segment, I want to give you just a bit from that revenue sourcing book where we talk about how currency has changed. And as much as currency has changed in the past, I expect we're going to see even more dramatic changes moving ahead. See, after World War II, as the revenue sourcing book documents, as part of the Bretton Woods Agreement, the U.S. dollar was made the reserve currency of the world. Now, the dollar at the time was the most desirable currency in the world because it could be exchanged for gold at any time at a rate of $35 an ounce. So because of this convertibility to gold, all countries around the world were very comfortable using the U.S. dollar, and all international trade, or I should say nearly all international trade, took place in U.S. dollars. Now, that system of the dollar being backed by gold began to unravel in the 1960s with massive U.S. government spending. Medicare, Medicaid, the war on poverty, the Vietnam War, huge drain on the U.S. budget. These programs were extremely expensive, and the politicians had three choices to fund the budget deficit. They could raise taxes, they could cut spending, or print currency, and predictably, the politicians then did what the politicians are doing now. They decided to turn on the money printing machine. Well, it didn't take long for foreign investors and banks to get nervous, and they decided that they'd rather have the gold than they would the dollars. So they started to exchange their dollars for gold, and because these foreign demands to exchange U.S. dollars for gold got so great, President Richard Nixon at the time had no choice but to close the gold window. In fact, in 1971, he went on television and said he had to temporarily suspend the redemptions of U.S. dollars for gold. You can see a transcript of his speech in the Revenue Sourcing book, available at revenuesourcingbook.com. But in his speech, he blamed this action on the international currency speculators. Well, Mr. Nixon, in that speech, followed every rule of politics. Rule number 1, never blame yourself. Number 2, seem sincere about a solution even when it's blatantly obvious you're not sincere. And number 3, tell people what they want to hear. During that speech, Mr. Nixon said that the dollar will buy just as much tomorrow as it does today. That's a whopper so big that even Pinocchio would have blushed. The 1971 facts are this. The average sale price of a home in the United States in 1971 was $24,000. The price of gold was $35 an ounce. That means it took 685 ounces of gold to buy the average new home. Today, gold is about $2,000 an ounce. The average new home costs about $320,000, which means if you have 685 ounces of gold today, you can buy nearly 4 houses. 685 ounces of gold bought one average home in 1971. Today it buys almost 4. Is that because an ounce of gold is inherently more valuable today than it was in 1971? Obviously not. It just means the dollar buys that much less. That's why it's important for you to have a copy of the Revenue Sourcing book. The Revenue Sourcing book talks to you about using the 2-bucket approach to manage your investments. You want to make sure to manage against a stock market crash and a deflationary outcome, but also protect yourself from an inflationary outcome. The book outlines a strategy that you can consider. I would strongly encourage you to get a copy of the book if you've not yet done it. Again, revenuesourcingbook.com is the website. Also, if you're just tuning in at the end of the program here, we do have a new Retirement Lifestyle Advocates app. All you need to do to get a copy of the app is visit retirementlifestyleadvocates.com and download the app. Using that app, you'll get a copy of our weekly newsletter as well as access to the podcast and the weekly client-only investment update webinars. That's all the time I have for this week. Hope you'll tune in again next week. Have a terrific week.